So you want to own a holding company. Imagine spending almost $1.6 billion in a single year buying businesses. Then imagine leaving many of those businesses under their own managers instead of absorbing everything into one giant corporation. That is very close to what Constellation Software does. The company at the top keeps buying companies, but it does not necessarily want to run every company from headquarters. So what exactly is the parent company doing? That question becomes more interesting when you see the scale. In 2025, Constellation Software generated more than $11.6 billion in revenue and about $1.7 billion in free cash flow available to shareholders. During that same year, it completed acquisitions with total consideration of roughly $1.6 billion. Then, in just the first quarter of 2026, it completed another $809 million of acquisitions. And when Constellation acquired a majority interest in DerbySoft through one of its operating groups in June 2026, it said DerbySoft was expected to continue operating independently under its existing leadership. Think about what that means. The company at the top can own the business without becoming the business. So where does the money come from? How much cash generated by each subsidiary can actually move upward? And why can $1 of profit become more useful once someone at the top can choose between 10 different places to invest it? That is the real economics of a holding company. From the outside, it looks like a collection of businesses. From the inside, it is a machine for deciding what happens to capital after those businesses earn it. The dream usually starts much smaller. Maybe you have $200,000 saved, and you find a boring local company whose owner wants to retire. HVAC, plumbing, commercial cleaning, pest control, industrial maintenance, something with repeat customers, employees already doing the work, and real cash flow. Building that company from zero might take years. Buying it means the customers, equipment, supplier relationships, employees, and revenue already exist. The problem is that a profitable business can cost several $million. That is where acquisition financing enters the picture. According to the U.S. Small Business Administration, the 7A program can be used for a complete or partial change of ownership, and an individual 7A loan can still be as large as $5 million. The SBA does not simply hand you the purchase price. You apply through a lender. The business has to demonstrate an ability to repay. The transaction has to satisfy lending requirements, and the exact financing structure depends on the deal. But financing creates leverage. Imagine a simplified $3 million acquisition. You contribute part of the purchase price. A lender finances another portion. The seller might finance part of the deal as well. Suddenly, a few $100,000 of buyer capital can sit underneath control of a multi-million-dollar operating company. That sounds like a shortcut to wealth. Then the first loan payment arrives. Leverage makes the upside larger because you control more assets with less equity. It also gives the business another fixed claim on its cash, and that changes what happens to every dollar the company earns. Suppose the company you bought produces $3 million in annual sales. That number sounds impressive. It tells you almost nothing about what you can actually take home. Payroll might consume $1.3 million. Materials and subcontractors could take another $700,000. Vehicles, rent, insurance, software, advertising, repairs, and administration might consume another $400,000. $3 million of sales has now become $600,000 before acquisition financing, taxes, equipment replacement, and working capital. Then the debt payment arrives. Then one of the vans needs replacing. Then your largest customer waits 60 days to pay an invoice. This is why holding company economics lives or dies on cash flow. The money sitting in a subsidiary's bank account is not automatically yours to remove. Some of it exists because payroll is due Friday. Some exists because taxes are due next month. Some exists because customers pay slowly. Some exists because the business has seasonal swing. Pull every available dollar into the parent company and you can make the holding company look wealthy while making the operating company dangerously weak. The owner has to decide how much cash the subsidiary genuinely needs. How much should remain available for emergencies? How much deserves to be reinvested? And only then, how much can safely move upward? With one company, that is difficult. With 10 companies, you are no longer collecting 10 profit checks. You are managing 10 competing demands for cash. Imagine buying a plumbing company that has been profitable for 25 years. The numbers look excellent. Then the owner retires. Within a few weeks, you discover that the owner knew the biggest property managers personally. He priced every large job. He knew which technician could handle which customer. Suppliers answered his calls because they had dealt with him for 2 decades. The financial statement said you bought a profitable company. What you actually bought may have been a profitable company attached to one person's brain. Now that person is gone. This is one of the most dangerous acquisition problems because it can hide behind years of good financial results. A holding company cannot scale if every acquisition requires the owner of the parent company to stand inside the subsidiary every morning. You might personally rescue company number 1. You might rescue company number 2, and by company number 5. You are driving between businesses, solving scheduling problems, calming customers, replacing managers, and answering questions that were supposed to stay inside the subsidiaries. At that point, you are no longer allocating capital. You are putting out fires. Businesses that fit a holding structure usually have some ability to survive the departure of the person who sold them. There are managers. Customer relationships belong to the company. Pricing is documented. Financial records are reliable. Employees know who makes decisions. Constellation's Derby Soft acquisition illustrates the opposite of founder dependence. Derby Soft was expected to continue operating independently under Ted Zhang, its existing chief executive. Constellation could acquire control without replacing the operating brain of the company on day 1. Every additional acquisition makes that distinction more important, because eventually the parent company has to stop running businesses. It has to start owning businesses that can run. Now you buy company number 2. This time something changes. Company 1 already has a controller, payroll system, insurance relationships, recruiting process, legal support, software, and financial reporting. Company 2 needs many of the same things. You could duplicate every cost, or you could ask which functions become cheaper or stronger when used twice. Maybe one finance team can oversee both subsidiaries. Maybe insurance can be negotiated across a larger group. Maybe recruiting, cybersecurity, treasury, software contracts, and reporting can be handled centrally. Now, Company 2 is creating value in 2 ways. It produces its own cash flow, and it may allow infrastructure you already paid for to serve more revenue. But there is a trap. Imagine a customer at Company 2 needs an urgent pricing decision. Before the acquisition, the local manager made the decision in 10 minutes. After the acquisition, the request goes to headquarters. Headquarters wants another report. Finance reviews the margin. Legal checks the contract. 2 days later, the customer has already called a competitor. The spreadsheet says centralization saved money. The customer says otherwise. This is why scale does not automatically make every function better. Constellation's model is interesting because decentralization is deliberate. Its operating groups and business units retain substantial autonomy instead of assuming headquarters should control every decision. The parent therefore faces a permanent question: which activities genuinely improve when shared across the group, and which ones become worse the farther they move from the customer? Now imagine both companies are healthy and sending cash upward. You have $500,000 available. Your HVAC company wants the money to open another branch. Management believes the expansion can produce an attractive return. Your plumbing company wants the same $500,000, but its local market is already crowded. Your acquisition debt is still outstanding. Paying it down would immediately reduce risk and interest expense. Then a retiring business owner calls. He wants to sell company number 3. 4 choices, 1 pile of cash. This is capital allocation, and this is where the job changes. A local manager naturally looks at their own company and asks, how can I make this business bigger? The person sitting above several companies has to ask a different question. Where will this dollar produce the best result for the entire group? Sometimes the answer is expansion. Sometimes it is debt reduction. Sometimes it is another acquisition. Sometimes the correct answer is doing nothing. Berkshire Hathaway shows what this looks like at enormous scale. Its 2025 SEC filing shows businesses spanning insurance, freight rail through BNSF, energy, manufacturing, services, retailing, automobile dealerships, aviation, and other industries. Berkshire's manufacturing, service, and retailing businesses alone produced more than $214 billion of revenue in 2025 and about $13.6 billion of net earnings. But those businesses do not need capital in the same way. A railroad can require billions of dollars of physical investment. Another subsidiary may generate large amounts of cash without needing comparable reinvestment. The parent can compare those opportunities. That is one of the most powerful things a holding company can do. A dollar is no longer trapped inside the business that earned it. It can potentially move to wherever the owner believes it will work hardest. This is where the roll-up becomes tempting. Imagine 5 small service businesses. One depends heavily on a single customer. Another depends on its founder. A third operates in one small market. A fourth has weak financial reporting. A fifth has no real management layer beneath the owner. Individually, each company looks fragile. Now imagine combining them under one group. Customer concentration falls. There are more managers. Revenue comes from several markets. Reporting improves. No single customer or founder determines whether the entire organization survives. The cash flow may become more predictable, and buyers sometimes pay higher valuation multiples for larger, more predictable businesses than for tiny, owner-dependent companies. That creates the possibility of multiple expansion. Possibility is the important word. Suppose you buy 5 businesses at relatively low earnings multiples, simply putting their logos underneath one. Parent company logo does not suddenly make them premium assets. If the companies remain dependent on founders, carry too much debt, lose customers, or become slower because headquarters interferes with every decision, the combined group can be worth less than you expected. The valuation only improves if the underlying cash flow becomes better, more diversified, better managed, better documented, less fragile. The value comes from changing the quality of the business. The logo at the top is irrelevant. Here's a simplified example. These are illustrative numbers, not market averages. You buy Company 1. It generates $500,000 a year of operating cash before acquisition financing, after debt payments, taxes, necessary equipment spending, and cash retained inside the business. $200,000 can safely move to the parent. You do not spend it. You build liquidity. Over the next few years, debt falls, pricing improves, and the company becomes more efficient. Now $300,000 a year can move upward. That accumulated capital helps fund Company 2. Company 2 also generates $500,000 before its acquisition financing. After its own obligations, perhaps another $200,000 becomes available. The parent now controls 2 businesses, producing $500,000 of distributable cash between them. Then you discover the companies are paying for duplicate accounting software, duplicate insurance administration, and duplicate back-office work. You eliminate $100,000 of cost without hurting operations. Available cash rises to $600,000. That money can reduce debt. It can fund expansion. Or it can help buy Company 3. After Company 3, perhaps, the group produces $800,000 of annual distributable cash. Now the machine begins feeding itself. Company 1 helped buy Company 2. Companies 1 and 2 helped buy Company 3. Company 3 can eventually help fund Company 4. But look at what else compounded. You now own 3 customer bases, 3 employee groups, 3 sets of equipment, 3 legal entities, multiple managers, multiple insurance programs, and several debt obligations. The cash flow compounded. The complexity compounded with it. Now take that machine and make it enormous. Constellation Software describes its business very simply. It acquires, manages, and builds vertical market software businesses. In 2025, revenue reached more than $11.6 billion, up 15% from the previous year. Acquisitions represented a major part of that growth. During the year, Constellation completed acquisitions with approximately $1.6 billion of total consideration. It generated roughly $2.7 billion in operating cash flow and about $1.7 billion in its reported measure of free cash flow available to shareholders. Then it kept buying. During the first quarter of 2026 alone, completed acquisitions represented another $809 million of total consideration. This is the holding company flywheel in real numbers. Existing businesses generate cash. Capital gets redeployed. Acquisitions add new cash-generating businesses. Those businesses can eventually contribute capital to another round of acquisitions. And the process repeats. Constellation does not need every acquired business to become identical. Darbysoft could continue under existing leadership. The parent company's advantage comes partly from repeatedly finding, evaluating, acquiring, and holding specialized businesses. After enough repetitions, something important happens. Buying companies itself becomes an organizational capability. The first acquisition is an event. The 100th acquisition is a process. Without financing, building the group can be painfully slow. Imagine Company 1 sends $300,000 a year to the parent. The next attractive acquisition requires $1 million of equity. Waiting for internally generated cash could take years. Debt compresses that timeline. You gain control of the next asset earlier, and its future cash flow can help support the financing used to acquire it. When everything works, equity can compound faster, but debt gives every problem a clock. Lose a major customer, and the payment is still due. Enter a recession, and the payment is still due. A subsidiary needs emergency equipment, and the payment is still due. Now imagine several leveraged subsidiaries sitting underneath the same parent. Company A has a weak year and needs cash. The parent uses money generated by Company B to support it. Then Company C suddenly needs expensive equipment. Company D loses a customer. The businesses that were supposed to diversify your risk are now competing for the same emergency liquidity. This is where the number of companies you own becomes almost meaningless. 5 conservatively financed businesses with substantial liquidity may survive. Conditions that destroy a 20-company empire built with thin margins and aggressive borrowing. Growth can create resilience. Debt determines how much stress that resilience can survive. The first acquisition gets examined from every angle. You check the customers. You check the debt. You check the employees. You check the equipment. You question every assumption because one bad deal could destroy you. Then you complete another acquisition. Then another. By the 10th deal, buying businesses can start to feel normal. That is dangerous. More acquisitions create more revenue. More revenue makes the group look bigger. A bigger group may attract more financing. More financing makes another acquisition possible. Eventually, the organization can begin buying companies because buying companies is what the organization does. Now the flywheel can become a treadmill. Every new acquisition still has to compete against every other use of capital. Maybe paying down debt produces the better risk-adjusted return. Maybe an existing subsidiary has an exceptional expansion opportunity. Maybe acquisition prices have become too expensive. Maybe the economy is weakening and liquidity is worth more than another company. Constellation's scale shows why this decision sits at the center of the model. Timing, financing, other investments, and accounting all matter, but at billion-dollar scale, acquisition is competing against every other use of capital, not simply happening on its own. Once you build a holding company, buying another business stops being a special event. It becomes one of several recurring answers to the same question. What should we do with the next dollar? Eventually, one of your subsidiaries becomes extremely valuable. Now another decision appears. Sell it or keep collecting the cash? Selling can turn years of work into one enormous payment. Debt can be repaid. Investors can receive capital. The owner can move on. Holding creates a different kind of value. A strong subsidiary can produce cash next year, and the year after that. And 10 years later, the parent retains the ability to redirect that cash toward whatever opportunity appears next. Berkshire Hathaway is famous for the long-duration version of this structure. Constellation similarly emphasizes acquiring, managing, and building vertical market software businesses, rather than treating every acquisition as inventory for a quick resale. Long-term ownership can also affect which companies are willing to sell to you. Imagine you spent 30 years building a business. Price matters. But you may also care about your employees, your customers, your management team, and whether the company still exists in recognizable form after you leave. An acquirer known for allowing strong businesses to remain autonomous can offer something another buyer cannot. A future for the company after the founder's check clears. That can become an acquisition advantage of its own. Go back to the beginning. You wanted 10 companies, then 20. You imagined multiple streams of profit flowing upward into one account. The real structure is far more demanding. Every subsidiary still has to earn customers, pay employees, maintain equipment, manage working capital, and survive bad years. Some businesses will need cash. Others will produce excess cash. Some deserve expansion. Some deserve to be left alone. One acquisition may become the best investment you ever make. Another may consume the profits of 3 healthy companies before you finally admit it was a mistake. The parent company sits above all of them. Constellation and Berkshire sit at opposite ends of the same idea. One still deploying enormous amounts of capital into acquisitions. The other already overseeing everything from insurance and railroads to energy, manufacturing, services, and retail. The companies are radically different. But eventually, the same question reaches the top. Where should the next dollar go? That is the business you are really entering when you build a holding company. You are purchasing the right to allocate the future cash flows of multiple businesses. Sometimes the next dollar buys another company. Sometimes it opens another location. Sometimes it replaces equipment. Sometimes it reduces debt. And sometimes the smartest decision is keeping the dollar in cash and waiting. So if you want to own a holding company, the number of businesses may be the least interesting number on the page, because eventually 10 companies will all want the same dollar. And when you sit at the top, deciding which one gets it becomes your real job. Get that decision right often enough, and the machine compounds. Get it wrong often enough, and the empire eventually starts financing its own collapse.